Welcome back. It's not just the traders on Wall Street that are keenly following inflation and its effect on interest rates. Well, Americans across the country are bracing for high inflation to stick around over the next few years. According to a key Federal Reserve Bank of New York survey published Monday, the median expectation was that the inflation rate will be up to 3.3% 1 year from now, according to the New York Federal Reserve Survey of Consumer Expectations. Now, an increase from 3% rate was an increase from 3% on top of the previous month's recording. Now, consumers also anticipate that the inflation will remain abnormally high in the coming years, projecting that it will hover around that 2.8% 3 years from now and remain there 5 years from now. That's an increase up from March's 2.6 reading, according to the survey. Now, maybe Americans are starting to get the memo. Inflation is stickier than anybody had predicted. Now, Fed Chair Jerome Powell has repeatedly stressed that policymakers are committed to wrangling inflation back to that 2% goal, and that's their target before they even begin to start to reduce interest rates. Newsflash, that's going to be difficult, if not impossible, in the short term. Now, pundits will say that jobs are still strong, right? I say those numbers are beginning to weaken, and the data looks like it's starting to crack to me. Now, the key thing going forward is probably going to be mostly about earnings and that earnings picture. Now, if earnings stay strong, well, that's going to build a base for asset prices to grow for now. If earnings falter, well, that's going to be a big deal, right? My next guest is a money guy. Welcome into the show, Mr. Craig Bolanos, CEO and co-founder of the Wealth Management Group in Chicago. All right, that was my monologue. Rip it apart if you like, but I think it just tells me, and there's other surveys out there I didn't mention because I didn't want it to be too long, that the consumer is now starting to think, hey, we're not getting out of this that quickly. What do you think?
Well, listen, your monologue wasn't as good as Johnny Carson back in the 80s because I wasn't laughing at all. I mean, you're talking about serious stuff, and I get it. The consumer's reminded every single day for the price of the pump, the grocery store, that the inflation's not coming down. But Scott, I'm going to make an argument. Given the consumer is anticipating that there's no break in inflation, given the consumer thinks the inflation might actually get marginally worse, that may cause the consumer to start tightening their belt and buckling down on some of their excess spending, which in turn will lower the amount of money being spent on retail, which in turn will lower the economic growth, which in turn will create a self-fulfilling prophecy that the Fed's right. We do get to 2+ inflation in the days to come, and throw in what you said, a labor market that starts to get a little bit worse. That'll create some demand destruction as well. So I think all things point that inflation is going to go lower over the next year and a half, not stay where it currently is. That's my take on a Tuesday afternoon.
Okay, well, we're going to put you down as an optimist then. We've got that duly noted. Thank you very much. How about this, though? We've got some commodity prices on the comeback. I'm not talking about corn, wheat, and beans, but you've seen what's happened to, say, cocoa, coffee. They've taken coffee out of the CPI, by the way. If you knew that, I don't know, because it's obviously too high, and they don't want that to be part of the reading. But I say this. Housing, we're going to do that next segment with Mr. Tommy Grisafi, but housing is getting more and more difficult because of the shortage of housing. But when you throw on to the fact that we've spent $10 trillion at the government level, federal level, and at the same time we've let in 10 million people, that doesn't bode well for me. That's kind of a powder keg of inflation waiting to happen, if you ask me. So I say that we've still got some issues out there. We can't stop the government from spending, and we can't stop people from coming in. How does that end? That's only going to be creating more demand for housing, or at least something to rent. And that's only going to make the government have to continue to spend more money from people that didn't put into the system. And so I think that looks terribly inflationary just from my little seat here. What do you say?
Well, anytime you print more of something, that something becomes worth less. And the fact that the fiscal stimulus is working against the monetary policy, that's a problem we all know. I mean, we need to get the government to get out of our own way. That's the truth, but that's what elections are for. But Scott, I come back to something else that I think is pretty darn simple. I just saw come across the press wire that we're going to have the highest student loan interest rates in more than a decade.
Wow.
And when parents are borrowing at 9.08%, let me say that again, student loans for the upcoming year, 24-25, are going to be at 9%. That too is going to create a pinch on the consumer. That's going to slow down the demand, which again is going to slow down the what? Slow down the inflation. So I think the consumer's expectations are just a little bit off. Go ahead. You paused there.
Yeah, because there's no worry. They're going to be forgiven anyway. It could be 28%. Nobody cares.
Oh, please. They're not going to. These are the student loans that aren't getting forgiven.
They're just going to be forgiven. I mean, there's no big deal. All right. So do they reset every year? And what was last year's rate?
Yeah, they reset every year. So it was already getting expensive. For the 23-24 season, Parent Plus loans were being borrowed at a rate of 7. Now we're borrowing at a rate of 9. And maybe that doesn't seem like a big deal, but when you look at the cost of a college education today and you add 2 percentage points of drag to be paid over the amortization of that loan, which is typically 10 years, this is a very, very big deal. If 2% higher rates was enough to show some cracks in what I call the housing market, I think a 2% higher rate might just start be what develops some changes in the graduate and undergraduate loan market.
Okay, so I'm hearing from you that you and I need to go out and look for some stocks that have a lot to do with vocational schools, right? We need to be buying those things because there might be a rush to those things outside of the universities. Who knows? But anyway.
I think you should book Mike Rowe as your next guest and talk about dirty jobs because that's where the trend is coming.
All right. That's an awesome idea. We got to break it off there. That's super stuff. Always great to have you on, Craig. We'll definitely look forward to seeing you again next week. Craig Bolanos, he's a CEO and co-founder of the Wealth Management Group up in Chicago. All right.